Thanks very much. Absolute pleasure to be up here today. It's probably the other way around. Koshi gives me a hard time. I don't tend to give Koshi a hard time. What I've got to do today is probably talk to you about 30 to 40 minutes about what's going on in the economy. And I'm not sure if you're aware, but working for a bank like CBA, it makes our job as economists a little bit easier because we are the largest retail bank across the country and we've touched a lot of different customers, business and retail. And what it does is it provides us with an amazing data set that we get our hands on. So I want to talk to you the anecdotal stuff about what we're seeing in the economy. I'm not sure if you're aware that we can take every FPOS transaction, debit card and credit card transaction that takes place through a CBA merchant facility, and we can break that up within 24 hours and see which sector across Australia is spending, break it up by postcode, demographic, income group, within 24 hours. That's how powerful the data is. Obviously, we keep all that privacy in play, but it's so powerful that we actually now provide that to the Reserve Bank as well as the Treasurer's Office on a monthly basis. So I will talk to you about what's taking place on that front. In terms of the presentation, the title of the presentation, Living in Remarkable Times, and I think it's probably apt in this sort of environment. I want to talk to you about it from a technology sense, but also what the implications are for investment, business, going forward. I guess in terms of what are we seeing at the moment, and if you went back to late last year, we really hit a purple patch across the Australian economy. Things were motoring along in that December quarter at a phenomenal pace. And then we had the election called, and the first 6 months of this year, the economy virtually came to a standstill. We could see it across the bank in terms of the transactions that were going through. And I've got to say that, it sort of died. For the last 6 to 7 weeks, we have seen a pretty substantial lift, credible lift, incremental lift that's coming through in retail activity, PAYG going into bank accounts or out of bank accounts in terms of the tax, the GST revenue that's going out. So that's all giving us a deal of encouragement that the economy is just starting to lift. And I'll talk to you about some of that stuff that we're seeing through. The usual compliance slide. There is no one here from CBA Compliance. I could probably skip it, but I might get in trouble. Just let you know it is a general presentation and doesn't take into account any personal investment objectives. So just in terms of the hurdles that we have across the globe at the moment, it's pretty clear that we've cleared a couple of key ones, and that's the Brexit story and the federal election. I think the federal budget is something that's going to be an evolving story over the next couple of years. But the real story right now is US rate hikes and the US election. Now, stock markets have not priced themselves for a Donald Trump victory. That's pretty clear. And I think, if Trump did, by some off-chance win, it will certainly have a substantial impact on markets in terms of a pretty substantial pullback for US stock markets, which are almost bouncing off record highs. I think the volatility in the political aspects is something that the market wouldn't be able to take, but it doesn't look like that's going to be the case. When it comes to US rate hikes, it's important to think about what does it mean for you as customers, you as businesses, and we've already seen that in the last 3 to 4 weeks, we might have low rates here in Australia, but the 2, 5, 10-year rates are all up about 30 basis points. So you're seeing those medium-term rates in Australia already starting to lift. And the reason they're lifting is on the back of US growth, the US recovery and the talk of a US rate hike coming in December. So I'll talk to you about the US in a second, but what are we seeing out of world growth? And if you look at the IMF, they're talking about 3.1% growth for the global economy. The key drivers of that is quite amazing when you think that the 2 or 3 key drivers are China, US and India. You take those out and the rest of the world looks pretty weak in terms of the contribution to world growth. And China certainly front and center. They're double almost what the US is in terms of the growth story. Now, if we look at the US, I think it's ironic. They got us into the global financial crisis. They've come out the other side, and that economy is motoring along at a pretty healthy clip now. I think if you look at the US growth story, and that's the unemployment rate in the US and how it's come down since the GFC, the peaks of the GFC. And what's really interesting is those people that go out and claim jobless unemployment benefits for the first time in the US, it's at the lowest level since 1970s, the mid-1970s now. And what's probably more encouraging is that wage inflation is just starting to lift. So they're starting to pay their workers a little bit more. The economy is starting to heat up. The housing sector is very, very strong. And more importantly, the Fed wants to keep inflation at around 2%. And I think next week we'll see it's about 1.7, 1.8%. So that's why the market's saying a rate hike's around the corner. Now that rate hike we expect is in December. The problem is what happens after that rate hike. That's the unknown. Is rates rising once, twice, 3 times? We only expect 1 rate hike a year in the US for the next 3 years after that rate hike. But I think the risk is that the Fed in the US raises a lot quicker than that. So if they raise twice or 3 times next year, those medium-term rates, even in Australia, will start to lift. So it doesn't affect the resi market, but I think commercial rates in particular is where this issue starts to come in. And we've already seen it starting to come through. No doubt, that's where you sort of think, well, if you've got long-term rates lifting, that's a much better story for the likes of QBE. And if anyone's seen QBE's share price in the last couple of weeks, good $1.50 increase in the last few weeks, just off the back of the talk of US lifting rates. So we're comfortable about the US growth story. The other part of the world is no doubt the Eurozone. And I talked about Brexit being done and dusted, but I think the key here is that the Brexit scenario we expect will lead to a shallow recession in the UK. All the medium-sized businesses at the moment are very happy about life in the UK, but I think the medium-term prospects for the UK is what can they get out of this EU in terms of the trade deal. And if they are unable to get the financial passport, there's a lot of uncertainty over the next 2 years. Big business is going to pull back investment. And we saw what happened when the mining sector in WA, Queensland, when the mining sector, the big guys pull back in investment, it feeds through the economy. And so we expect a shallow recession for the UK next year. The pound, I think, has hit a 31-year low last week. And you've got to think that the EU is not going to make it easy for the UK to leave. Because if they do, it opens the door for a number of other countries to do the same thing. So I think it's pretty clear the French president, the German president are going to take a pretty hard stance when it comes to the UK leaving. What are we seeing out of China? It's interesting because if you've read anything that we've written over the last 4 or 5 years, we've been very upbeat the Chinese economy. We were a little concerned last year about the property sector, but the economy from our perspective is doing a lot better now, and we're a lot more confident now than we were even 12 months ago. China's going through a transition phase, just the same that we are here in Australia. The important fact is they're transitioning at a very slow pace, and they're very careful about how they do it. Now, you've had the mining boom, even here in WA, in Queensland, but our ag economists coined the term the dining boom. And this is food exports to China from Australia. A few years ago, we were exporting just under $1 billion in food exports. We're now hitting almost $6 billion, and it's rising at such a rapid pace. It shows you what the power of this Chinese consumer gaining a bit of income means over the medium term. And I think what you've got to take into consideration is when you look at super economies like Japan, Taiwan, South Korea, you know, they took 40 years to go from these low-income economies to these super-income economies. And what they did was shift rural workers to the capital cities, and the wages lifted. That urbanization rate is essentially at about 70 or 80%. In China, that urbanization rate is around 58%. It's lifting by 1% a year. So over the next 2 to 3 decades, you will see their income levels continue to lift. And as that does, the demand for Australian exports is going to lift with it. And I think that's one angle that's supporting the Australian growth story. The other, I think, is the tourism angle. This is a graph of our number one tourist group, New Zealand, the blue line, and the red line is our tourists from China and Hong Kong. And you can see there, they've now surpassed New Zealand. We've got 1.4 million tourists coming from China and Hong Kong on a yearly basis. I went back to 2003 and had a look at the data, and we had 3,000 tourists coming from China on a monthly basis back in 2003. That is quite staggering. The growth rate's about 22, 23%. What's really interesting is there's less than 10% of Chinese at the moment have a passport. So what does that mean as your income lifts? More people decide to travel overseas. You're going to see a huge influx of Asian tourists to Australia. The real kicker on that front is if the average US tourist spends around $4,000 when they're here on the average trip that they're in Australia, the average Chinese tourist is spending something like $8,000. So the income boost to Australia and the capital cities like Sydney, Melbourne and Brisbane in particular, that's where the key driver is. So you ask yourself the question, why is the Reserve Bank looking to push the Australian dollar down? And it's to drive the service sectors in Australia. If we've got a mining boom that's coming off, these are the sectors they want to see growing. Now, it's not just agriculture. We've signed this massive free trade agreement with China, And it's opened up the door to an array of sectors. And, the Reserve Bank talks about financial services, education, healthcare. Australian business now has a real opportunity to grow their customer base very, very quickly. Australian products are really well trusted. So we are comfortable about the Chinese economy and how it's evolving. I think it's going to provide dividends over the medium term. It is interesting that you still have the commodity boom story taking place, but now it's not an investment boom, it's a production boom. So that's the key story here in Australia. If you look at Australian commodities, we're shipping out record volumes, and I think the gas projects even here in Brisbane that have been in Queensland that have been pulled back, over the next couple of years you will see they'll come back and drill for that gas. I think you look at the materials sector on the stock market, it's up 30% in the last 6 months. And even thermal coal up 80-90% in the last 6 months. So you're seeing a huge rebound in commodity prices, all off the back of the fact that the Chinese economy is starting to strengthen. It's interesting in China, there's a lot of reports that you may have seen in the last couple of weeks that they built all these buildings 20 or 30 years ago and they didn't follow a lot of the current regulations. So they're going to be pulling down cities worth of these buildings and rebuilding them over the next 5 to 10 years. And that's going to require a huge amount of steel demand. And no doubt those resources come from a few places and Australia is really well placed. The problem is that, yes, we'll be shipping out a lot more, but if you take even like a gas project in the Northern Territory, those gas projects, if you had 10 workers build the project, you only need 2 guys to run it when it's up and running. So it doesn't create the same amount of jobs when you've built the mines. So what are we seeing out of Australia? Look, from our perspective, I don't like the word recession because I've got a stock take of a few points up there and it shows you that the Australian economy is doing pretty well. You look at that and we've got world-leading growth, a jobless rate at a 3-year low, record car sales, record dwelling starts, record tourist arrivals, spending's okay, business conditions at 8-year highs. And if you actually look at the Reserve Bank's forecast for growth, it suggests that growth is going to lift over the next couple of years. So if you're investing in this market, you've got to think to yourself, the macroeconomic picture, is that looking good? And from our perspective, it's looking a lot healthier now than it was even 2 years ago. And that's important because if that all starts to crumble, well then you don't want to be going out there and investing in that environment because across all asset classes you're going to have issues. So we're actually a lot more encouraged by the global picture and also what's starting to take place here in Australia. I'm not sure if you saw, we released the State of the States report on yesterday. The report generates a lot of interest with the media and particularly the politicians. We tend to see if you're at the top rankings on the report, you love it, and the next quarter if you're at the bottom, the politicians tend to rubbish the report. So, and what we look at is 8 economic indicators. So we take stuff like retail trade, construction, unemployment, dwelling starts, population, and we try and see how that state is compared with its decade average. And up until 2 years ago, WA was front and centre, WA and the NT. And then 2 years ago, New South Wales took the top spot, surpassed Western Australia, and it's moved into #1 spot. It generated so much coverage that one of the betting agencies came out with odds for the next quarter's report. They were paying $4 for New South Wales to hold the top spot the following quarter, which is quite interesting because it's not an ASIC product, but my boss certainly wouldn't let us have a punt on it, so there you go. So look, New South Wales was top spot, and at that point we wrote a paper saying we'd expect the whole eastern seaboard to follow suit. And the reasoning behind it is it's not just home building, which is the key driver, but what's holding New South Wales and Victoria and the ACT up so well is the second leg of the growth story, public-private infrastructure. So the government stepping in, supporting infrastructure, driving investment, and then the private sector goes, hang on a sec, I feel confident, I'll jump in and support the investment story. I can see a way to make a profit out of this. And that's really rippling through those 3 economies now. So much so that you would have seen on last Thursday, New South Wales unemployment fell below 5% for the first time in 4 years. A sub 5% unemployment rate. It's quite amazing that we're actually seeing wage growth coming through in New South Wales, just starting to lift in a few sectors. We would have thought at that time that it would shift north, but I have to say that it has been a tough period for Queensland. The housing sector's done well over the last few years. But the rest of the state, I think, has found it a really difficult story, and particularly the business sector. I think they've held off in terms of the investment flavour, and that's unfortunately hurt the labour market and hurt the Queensland economy overall. But we look at Queensland and say, it's got all the ingredients you want for the next 2 years for growth. And that comes with tourism, the ag sector, the low dollar boosting the education sector. I'm not sure if you're aware, but education is our third biggest export now, behind iron ore and coal. It's growing at about 15%. I think it's worth about $20 billion a year. And it's going back to levels that we saw pre-GFC. Because when the dollar hit parity, all those international students decided they're not coming to Australia, they're going to go to the rest of the world. Now with the dollar back at 75 cents, it looks a lot more economically viable to come here. So you're seeing private equity moving into student ACOM, and that's a big story, not just for Brisbane and Queensland and North and South Queensland, but even for South Australia, where education's a really big story for Adelaide. So I think, there's certainly a lot of momentum to come. And importantly, those gas projects and the lift in thermal coal prices, some of these miners are starting to look once again at reopening some mines. I think that's going to be still some way off. When we go west, our perspective is that the Northern Territory, well, it's doing well at the moment in 4th place, but the momentum's coming off at a greater knots. Those gas projects are coming to completion. They don't really have much else behind it to support growth. The other problem is the population growth in the NT is just 0.4%. It's just the birth rate that's keeping it up. And so that creates some serious issues. If you can't keep people coming in, you've got a real issue. And from our perspective, that's the problem that Queensland's got at the moment. You think of any other time in history when New South Wales and Victorian property prices, Sydney house prices are 50%, the median house price is 50% above Brisbane, you would have seen young Australians travelling north over the border in droves. They would have been looking for that big house with a backyard to start a family and an affordable living and a comfortable life. It's not happening this time around. If you actually look at the data over the last, I think Queensland overall, the interstate migration story is bouncing off some of the weakest levels that we've had in about just over a decade of 10 or 15 years. So it's lifting off those levels, which is encouraging, but it just highlights that if you don't get the job story right, you're not going to get that migration story to come through. And I think that's something that, it's challenges for the government, but they've got all the key ingredients to support that going forward. So Western Australia, it's holding up as well as it can in this sort of environment. Retail trade is okay. But you can see what I'm trying to highlight here is that there's so much of a vast difference across the country, and the Reserve Bank has one blunt instrument like interest rates to try and support the whole national story. So it makes it very, very difficult. I'm not sure if anyone saw the Reserve Bank Governor Glenn Stevens, the outgoing governor's last speech, but it was probably the most honest, open, it was a seminal speech that just highlighted what the governor thought about what's taking place across the economy. And he made the point that in Australia, they have cut rates, not because essentially they wanted to, but because they were forced to by what's happening on a global front. And he also made the point negative rates don't work. We've seen what's happening in Europe with negative rates. I think there's a couple of banks in Europe now that if you're a customer and you keep your money overnight, they will take money off you the next morning. It just is not a system that's going to function well. And I think what the governor was trying to highlight is that it's up to governments, not just in Australia, but across the globe, to support the growth story. And that doesn't mean play the politics and stay on the sidelines. It means driving infrastructure. This is the cheapest in generations to borrow money for governments. You're not going to get this opportunity again. You can build capacity in your economy. And I think that's something the Reserve Bank's trying to tell government. We can't drive growth by just cutting rates. It's not working. We need to have the government step in and support the growth story. So what are we seeing on the jobs front? And this is key. I think if you look across the states and territories, this is employment compared to its decade average. And no doubt the NT is still very, very good in the labour market front, but as I said, the momentum story is coming out. And you can see here that these states down here, unemployment is above its decade average. So it's a little bit worse than obviously what it was. No surprises, the resource states of Queensland and WA are in that mix. But like I said, I am encouraged over the last 6 to 7 weeks of what's taking place and the lift that seems to be coming through in activity. The other thing to consider is the population story. And you can see there Victoria is miles ahead of the other states when it comes to population growth. Some of those stats suggest that, by 2040 or 2050, Victoria will be a larger city than Sydney. Melbourne will be a larger city than Sydney, which is quite amazing when you sort of think about it. Under those metrics. I guess in terms of where are we spending our money, this is actually quite interesting data. It's not published. We paid the ABS to get these statistics, but what it shows you is that households are out there spending on life's little luxuries, if you'd like. You can see there amusement, sporting goods, toys, video games, footwear, camping equipment, all that sort of stuff, watches, jewellery, all doing really, really well. In fact, I think if we looked at this data, and this is taking into account inflation, clothing retailers had the best last quarter in about 6 or 7 years. So I think the cold snap of weather that we had over the winter, we all went out and upgraded our wardrobes. And then we saw that takeaway food, 4.7%, and then we've just had the latest round of data which shows that takeaway food now, compared with 12 months ago, is growing at 11%. So I'm not sure what's going on. It's almost like we all watch MasterChef, but no one's in the kitchen. It's just phenomenal that takeaway food. I think it's also got to do with those apps, Foodora and Deliveroo, and everyone sort of can order good quality. Takeaway is not McDonald's or fast food anymore. It's the broad range of restaurants, and that must be a key driver of the what's taking place there. Encouraging to see the lift in that big area, department stores, and these guys like Bunnings, hardware, building, garden supplies, doing really, really well. I think you go back to early last year and they had some of the best quarters we'd seen in about 14 years. So this is growth on top of that. So they're doing really, really well. The other end of the spectrum is newspaper and books. You can see there that's a technology issue as well. Third consecutive year of negative growth. If you take the dollar spend in Australia on newspaper and books, and keep in mind you've even got inflation, right? But the dollar spend is, you've got to go back 2 decades to see us spend as little as what we are on newspaper and books now. So you can understand why the newspapers are cutting jobs the way they are and trying to restructure. And it's a similar story, I guess, for some of those key media outlets. So you can see that it is quite encouraging that we're spending on those sort of the household discretionary items. What gives us another degree of encouragement is households are now telling us that family finances are at the best levels since the global financial crisis. And they're saying that it's the best time in about 3 or 4 years to go out and buy a major household item. So this is the data that we've received in the last few months. So it gives us a pretty good indication that we've just coming into spring, we've got Christmas around the corner, and we're quite encouraged about what Christmas spending is going to look like. And go back in history, and the retailers had to discount because the dollar was at parity. They had to compete with the online retailers. But this time around, I think it's a different story. In fact, for the first time in Australia's history, we're actually seeing that outbound air freight is greater than the inbound air freight. So I'm not sure what's going on there, but we just looked at the stats about 2 weeks ago. But it may be that we're actually shipping stuff off in terms of for maybe countries that look at the dollar and it's cheap and they can buy goods here and ship it out offshore. But to think that outbound air freight, we're in a country that doesn't really make that much, it's quite an interesting story. You can see this is the Business Conditions Index. It's been going for a long time. It says businesses are telling us that conditions are at the highest levels in 8 years. So that gives us a degree of encouragement. But the problem with business is they're saying conditions are good, but we don't want to borrow any money. We're right, we don't want to invest, we just want to manage what we've got at the moment. So no one's out there trying to really drive investment. And I think it's really got to start at the top end of town, so the big ASX 200, the big corporates, the big private sector companies, because you're not going to get a mum and dad or a small business driving infrastructure and driving spending and CapEx. It's got to come from the top end of town. What do we expect for the housing sector? Look, I think if you look at it nationally, you're certainly seeing a very different picture. We've had phenomenal growth in those 3 key economies down in Sydney, Melbourne and the ACT in Canberra. And that growth continues to, I think, if anything, strengthen. The interesting thing here is people call it a property bubble. And if you talk to globally the investors and the fund managers, this is the one thing they can't get their heads around. How did Australia survive a global financial crisis? Your property market is 20 or 30% overvalued. But I sort of look at it and say, well, if we are overvalued by 20 or 30%, what's going to make it collapse? And it's got to be one of two things. Either we're going to have mass unemployment and we can't pay our mortgages, or we have a huge lift in interest rates. And neither of those two look very, very likely at the moment. Now, I think there's pockets of weakness that will come up in the next 12 to 18 months, and that's to do with particularly the apartment market. Just too much overbuilding that will bring down rental yields, and we're already starting to see that happen. And from our perspective, I think the concerns lie in Melbourne and Brisbane, key from the apartment story. I think there is a fair bit of concern on that front. You sort of look at Sydney, and we've got a significant amount of new dwellings coming in. I think dwelling starts in Sydney are 67% above our decade average. But what's interesting is it's split out across Sydney. It's very broad, and the absorption rate, I think, is going to be okay for the Sydney market over the next 2 years. You sort of look at the other point I made about interest rates rising. And if we look across the CBA, we have something like $115 billion mortgage book, probably a little bit more now, and well above 70 to 75% of our customers are head-on mortgage repayments because they've elected to pay the higher rate of interest despite interest rates falling. And the Reserve Bank has made the point a number of times that a quarter of Australian households have 2 years' worth of mortgage repayments in redraw facilities at current interest rates. So even if they lose their job, the Reserve Bank's looking at the housing sector and saying, you're going to have these pockets of concern, but it's not on our wall of worry like it was last year. I think what the regulators did last year to the banks and telling them to tighten policy, watch your investment lending, has really tightened the screws around the lending scenario. It means now that investor finance is, I think, some of the weakest levels in around 6 years, and it's all owner-occupiers that are majority that are driving the market, which is encouraging nationally. Now, what do we see in terms of growth going forward? 5 to 7% growth in property prices over the next 12 months, on top of what we've had. No doubt it's going to be driven by the capital cities. You go regional and it's still taking some time to filter through. And it's the part of any economic cycle where you're lifting off the bottom that it does take time to get out to the regions. And I know there's a lot of places up here in the mining towns that are struggling, and you see it when you go west as well. So you've got to take each individual suburb or sector separately. But I think real land values are going to hold up relatively well. The issue is around that apartment market. And just to give you an idea, if you take the lift in Australian property prices over the last 3 years and you sort of look at that against the Chinese yuan, it almost suggests that property prices haven't gone anywhere because of the depreciation of our currency against the yuan. So I think foreign investment is still going to play a huge part in the demand for Australian property. And we're starting to see the real top end starting to move. I'm not sure if you remember when Barangaroo was released down in Sydney 3 years ago, 3.5 years ago. The apartments down there, a one-bedder was I think 1.1 mil. And they're now selling for about 2.2, roughly around that. And $20,000 to $30,000, I think about $30,000 a square metre now. But there's a last bit of freehold land that's coming up in the near the Opera House, 71 Macquarie Street, and they'll be releasing in about 2 or 3 weeks' time. And they're talking about 2-bedders from about 4 to 6 million, 3-bedders from 6 to 12. And what was interesting was when they released Barangaroo, they sold it all in 3 hours, 300 odd apartments, here in Australia and in Asia. This time around, they're saying we don't need to release it in Asia. There's enough demand in Australia to satisfy the 120 apartments we're going to release in a couple of weeks. So this is what I'm trying to say, that the market, the top end is starting to move. And I think, that market hasn't really taken off to the same extent as some of those other places. So where to for rates? Because obviously that's key for markets. And I think this is where you have to go back and look at the Reserve Bank. And next week, the Reserve Bank on Friday will release its statement of monetary policy. Now, it sounds like a long, boring title, but just go to the back of that, 70 or 80 page doorstopper, and you will find in the back of that the inflation and economic growth forecasts. And if you look at the Reserve Bank in terms of its inflation forecast, it doesn't think inflation is going to be above its 2 to 3% target band till sometime in 2019. So that gives you an indication of if the Reserve Bank needs to lift rates, right? So it's been such an opportunity cost holding cash over the last couple of years. And I think over the next couple of years, holding cash is probably going to be even more of an opportunity cost. Why? Because not only are rates in Australia not going to lift, even if they did lift, it's going to be so incremental. But more importantly, you've got negative rates in Europe, you've got negative rates in Japan. All of that money needs to find a home elsewhere. And you are seeing more of those investment flavour coming into the Australian market from overseas. I'm not sure if you're aware, about 45% of the Australian stock market is now owned by foreigners buying Australian assets. We just released the first 30-year Australian Commonwealth government bond in history. About 80% of that was bought by foreign investors. It was so heavily oversubscribed, and they want 2.5% on that 10-year bond because they're getting 1% or nothing if they go overseas. So that's where all that money flow will continue to support Australian assets. And I think that's why holding cash when the cash rate's at a record low and more likely to sort of go like this than even lift. And the other thing you've got to consider is previous to the GFC, the neutral for the economy for the cash rate was 5%. So that was when Federal Treasury said at 5%, the economy is balanced. Now, it might be that 3.75% is the neutral for the economy. Because the household, us, we're all not spending the way we did in the past. The business sector's not spending the way they did in the past. And it might just be that the Reserve Bank's trying to do some work on it, Treasury's trying to do some work, but it might just be that no longer is 5% the neutral cash rate. It might be somewhere in here. So we're going to be very incremental about lifting rates and getting back to that sort of level. The reason we're going to be cautious, well, that's inflation. And I think if you look at the CPI, you can see there it's holding at 1%. The Reserve Bank looks at the underlying measures. They take out oil and food and energy, and they want to look at the real hardcore numbers. The volatility takes out the volatility, and they want to see inflation holding between 2 and 3%. And you can see here it's at a record low. So we don't have inflation in this economy. And I think that all this talk about OPEC and oil prices and potential lift in oil prices, that'll add a little bit of inflation into the mix, but it's not going to drive a huge resurgence in inflation across the world. The world is fighting a deflationary threat more than an inflationary threat, I think, at the moment. And OPEC is going to find it very difficult to get Russia and Iran to agree with the Saudis to cut production. And I think you look at the data, it seems to suggest they're all pumping out its record volumes as much as they can. And that keeps the world oil markets well and truly oversupplied. So that's Australian inflation. This is world inflation. So this is the real issue, that if you do have these deflationary threat to the globe, this is probably more of a risk than anything else to the global economy. But it does mean that low rates are going to be here for a very long time. And I think this is the story about remarkable times, because the level of inflation, like to see inflation this low when rates are these sort of levels, it's quite staggering. But I think technology is playing such a big part in that story. The fact that it's so hard for businesses to go out there and raise prices in this environment. They sort of sit there and think, well, if I want to raise prices, you can go online, there's an app, you can do this, and it's so much cheaper to buy it elsewhere, and you can get it in a couple of days. So they're all fighting this technology issue, and it's leading to cheaper and cheaper pricing across everything that we're seeing. And the problem is that I think we talk technology and say, what a great and wonderful thing, and it is, but there's a lot of sectors that have been left behind, a lot of businesses and sectors and households that aren't in sectors that are being driven with the technology revolution. As a result of that, you start voting in a different fashion because you don't feel the government's there supporting and bringing along this story. And I think you look at the Australian election results that we've had, you look at the Brexit scenario, you look at the Trump that's come out of left field, and you're seeing this similar story evolve across the globe. Interestingly, though, I think if you look at the impact that technology is having, it's interesting even the impact it's having on the market as well, because you take the Australian property market, rather the share market, this is the All Ords since 2004, the blue line. That was the GFC, and you can see the returns are around 170% compared to the bottom at the GFC. If you take the All Ords Accumulation Index, which when you add dividends, the returns are almost 300%. So it just highlights to you the power of dividends. And we are one of the few nations in the world where dividends are, as high as they are compared with the rest of the world. And I think that's going to be a big supporter of the stock market going forward. But what's probably more so is that when you add technology, so the best performing sectors, if you'd like, it's the mid-cap 50. So it's not the top 50 companies in Australia, it's the next 50. So these guys are big enough to challenge the top guys in their industries, but they're much more flexible, they're much more agile on pricing, they move very, very quickly with technology, and they're up around 50 or 60% in the past 4 or 5 years. I think in the last 12 months they're up around 18%. And they're all big names that if you look them up, but it's the ones that can move with technology very, very quickly. The age-old question, what's the best asset class to hold? Shares, cash, property, bonds? And you can see we've indexed it back to 1989, and the share market took off, and then the GFC hit, came back, and residential property certainly well ahead of the share market at the moment. I would say, though, that the best returns over the next 2 years are going to probably be in the stock market. And the reason I say that is because of, one, how cheap money is at the moment, and two, with where the cash rate is, everyone continues to chase yield. And if you look at the All Ords index and the dividends, and you take out the cash rate currently, the return is almost historical highs. So the return on equities is very, very sound. And I think you look at, it's not, this is the issue that we're having, because all the banks, or rather all the companies, the ASX 200 are out there paying a profit and then paying huge dividends at the moment. And this is something that the Reserve Bank policymakers have talked about, that, in this sort of environment, I think businesses are better off, at the top ASX 200 are better off keeping that money and actually investing it on behalf of their customers, on behalf of their investors. Because if they give it to an investor as a dividend, it goes into a bank account at 1 or 2%. If business reinvests that money in this sort of environment, the internal rates of return over the next 5 years will be 5, 7, 8, 10%. And that's going to drive shareholder returns a lot more. And this is something I think that's been talked about a fair bit at the moment. But we certainly like the stock market, and I think certainly there's a number of sectors that will do quite well. In terms of the dollar, where to from here? There's no question that policymakers would love to see an Australian dollar closer to 70 cents rather than where it is at 76. I think what's ironic is that the dollar is higher now than compared with the start of the year, and we've had 2 rate cuts. So rate cuts in Australia is not keeping that Australian dollar down. What it's going to take is US lifting interest rates. Now, we have a rate cut penciled in on Melbourne Cup Day next week. We think the Reserve Bank potentially may cut rates again. We've had that rate call in for some time, but I think the new governor seems a little bit more hesitant to cut rates. He's sort of thinking, what's the value of these rate cuts? Is it necessary to cut again? So they may hold off on Melbourne Cup Day. It will come down to the inflation numbers out next week. Rather not next week, out on Wednesday, tomorrow. If inflation comes in, I think under 0.4, there is the chance the Reserve Bank may cut again next week. But if they don't cut it, we're done with cuts. I think they're so close to the bottom when it comes to interest rate cuts. But to push this dollar down, it is going to take US rate hikes more than anything else. And the important fact there is that, a lower dollar, no doubt boosting a number of different sectors like the export sectors. So just before I end up, look, I think the economy is doing relatively well in this environment. I think there's certainly the outlook over the next 12 months is a lot more rosy than what we've had. We would love to have had a stronger government, whichever side won in power, to get policy through Parliament. I think that we have an issue around tax reform in this country that needs to be talked about. And unfortunately, I don't think we can have that discussion with the makeup of the Senate and the House of Reps. But Standard & Poor's and the ratings agencies have said that there's probably a 1 in 3 chance that they will downgrade our credit rating over the next 2 years. because we're not having the informed discussions and we're not looking at ways to cut our debt and our expenditure. And I think there's a risk of that happening now, and if we want to avoid that, well, tax reform has to be on the agenda. And that doesn't just mean raising the GST. It means looking at the 110 taxes we have across Australia and looking at what's the most efficient taxes that need to be kept and what needs to be removed. And the other thing, of course, is no doubt around ageing population. We have serious issues over the next 20, 30 years around even, you look at dementia rates and how much more of the budget needs to go to healthcare, and then less and less gets allocated to infrastructure, education, and those create serious issues. So the unfortunate fact is we're not going to have these discussions, I think, until there's either a change in government or the ratings agency cuts, and then we have to start to do something about it. But look, the outlook overall over the next couple of years is relatively upbeat. We're quite upbeat on investment classes, as you can see, and generally we think the economy is doing relatively well. In terms of the forecast, I'll leave them up there. 2.75 to 3.25% growth. Inflation is certainly not an issue. Unemployment to drift back towards 5.5%. I think the key here is that the last 6 or 7 months, the labour market's been all about part-time jobs because the businesses have been managing their workforce, but you will see full-time jobs starting to lift over the next 6 to 12 months. And in fact, keep in mind, job vacancies in Australia are now at 3-year highs. So businesses are starting the process of hiring. It takes 3 or 4 months to get through the system, and that's what we're really waiting for, this unemployment number to come down. Cash rate, potentially one further rate cut. I think you can rule out a rate hike. The share market, we haven't had to alter our forecast for the last 12 months or so, but 57 to 5,900 mid next year. You add in dividends and there's some pretty decent returns. And you can see the dollar drifting back towards 70 cents over the next 12 months.